What's up everyone, it's Caddy with MoneyVest. So in today's video, we are going to be talking about Teladoc, ticker symbol TDOC, and I continue to do a lot of stock analysis videos to help you better understand whether companies are worth buying at these prices or not. Because Teladoc is one stock that is down significantly from its all-time highs. From back in 2021, the stock is down well over 97%, so pretty much losing almost all of its value. Now trading sub $10 per share, pretty much the same level as it was back in 2016. So we're coming down to about a 8-year low for this stock here. So hope you all enjoyed this video and find it helpful. Please make sure that you drop a like and subscribe to the channel. And again, links to our Discord and Patreon is going to be down below if you want to join. Of course, get access to our MoneyVest beta launch and unleash your inner analyst. And of course, do your full comprehensive fundamental analysis on individual stocks with over 20 plus years of historical data, fundamental charting, visualizations, over 100 plus financial metrics and MoneyVest metrics, as well as access to over 17,000 stocks. Link's going to be down below. We are running a huge discount right now for 51% off, and you can lock this pricing in for the beta launch for life, of course, until you cancel. But everyone is going to be eligible for the beta launch eventually once we do that on July 8th, 2024. So we're very excited. Again, links going to be down below with limited spots left. The first week of the month is the best time to join. So love to have you on board. So first things first, let's go over to Teladoc over here. So again, this is the entire platform. This is what you'll have access to eventually. Again, you can search any stock you want, over 17,000 that are listed on the US exchanges. We come over to Teladoc and you'll notice that the M score is about 3 for the company, trading at $9.78, which if you come over to the 5-year chart, you'll notice it's just been on a steep decline from well over $290, almost $300 back in February. It has pretty much been sold off down to where it is now. And if you come over to the chart, max chart, you'll see like a A-shape recovery pretty much going all the way up during the pandemic, during, of course, 2020, the hype of 2021, and then selling off over 97%, pretty much losing almost all of its value and trading down to just under $10. So if you come over to some of the MoneyVest metrics here, what you'll notice that let's just do a 5-year analysis on the company. It has grown the revenue and the gross profit, operating profit, seems to be growing, but of course it's been negative. So this right here is the negative numbers for operating losses. So the company's been spending a lot of money, I'm assuming, on selling, general administrative expenses, as well as research and development. However, the revenue's been growing very, very fast. I mean, it's gone from about $553 million to well over $2.6 billion. But of course, losses have been piling up as well. Even though gross profit has also increased, you can see the gross profit has gone up. Also, if you come over to a 7-year analysis, you'll notice a very nice consistent growth in revenue and gross profit, but because of their higher spending, they have not been profitable. So this is going to be the operating losses and the net losses for the company. This was due to 2022 because of the acquisition that the company had. I remember doing a couple videos about that as well. But if you remove for net income, this right here is again the consistent operating losses for the company year after year. Now coming over to some of the other things, such as the shares outstanding, they have gone up significantly over the last 7 years from 55 million to well over 164 million. So that's a lot of share dilution of over 21% compounded every single year. And hence it is why it is terrible for the company, and margins of course have been always negative for the company. Again, net margins driving down to as low as negative 500% and of course recovering back up, but still nonetheless it is negative for the company significantly, as we have seen that they have never really gone beyond at the positive 0% level. Now coming over to some of the efficiency table, everything seems to be highly inefficient because we've got negative return on assets, negative return on equity, negative return on invested capital, negative return on capital employed. CapEx as a percentage of revenue is about 6 to 7%, average about 3.5% over the last 7 years. Stock-based compensation, again, as a percentage of revenue, operating cash flow, and free cash flow, very, very high, well over 50 to 60%. So seems to be the company that is just issuing a lot of shares, giving compensation packages to new employees and executives as part of their stock-based compensation, not really any regards to the shareholders or investors for that matter, because shares outstanding have gone up and they're also issuing a lot of stock-based compensation as a percentage of overall revenue, operating cash flow, and free cash flow. Now, cash has been improving by almost 50%. But debt has also been increasing, and they've also got a positive net debt. They used to have negative net debt, seems like. A couple of years in 2018, 2019, they had more cash than debt on the balance sheet, and then a huge jump in 2020, and they have never been able to recover since, as the company's got more debt than cash on the balance sheet at the moment. Current ratio is good. Quick ratio is pretty solid. Debt to free cash flow is also very high because they've got a lot of debt relative to free cash flow. And other than that, solvency ratio 2023 really, really low at just over 5.7%. And we got a lot of goodwill as a percentage of assets at over 62 to 74%. So this right here is goodwill as a percentage of assets. Back in 2017, 80%, 64%, coming down to 60%, and a huge spike up to over 93%. I mean, just think about it's pretty much made up of goodwill, right? So this company has a lot of goodwill on their balance sheet. I'll take a look at that in the financial statements here in just a minute. And the valuation, of course, coming down to extremely low levels because of the 97% sell-off, and that's why it says cheap across the board for this stock. So coming over to fundamental analysis, first things first, let's quickly analyze the last several quarters. So let's just go to 12 quarters. If you take a look at revenues, and if you come over to, let's say, 12 quarters over here, again, you can see the consistent increase quarter over quarter. Gross profit over here has been also increasing. So March 31st quarter, and if you come down to operating income or net losses for the company, again, you'll start to see significant amount of losses for the company. If you remove 4 net losses, every single quarter has been a loss in terms of operating losses for the business. Now, one more thing, let's just go over to the balance sheet items, and let's come down to goodwill, which is going to be under current assets. So goodwill over here, this is going to be the entire goodwill. And it looks like it's come down. So on an annual basis, of course, it was well over 14 billion, 14.5 billion, came down to 1 billion, 1 billion. Maybe it's under a different intangible assets over here. Plot for that as well. And then again, current assets, we don't have anything else for the company. So really it's goodwill and intangible assets at the moment. And then if we plot for long-term debt, which is going to be over here, again, the company's got about the same amount of long-term debt of 1.5 billion as it does with cash of 1.1. So $400 million of positive net debt, as we mentioned in our previous analysis as well. Again, coming back to the last 12 quarters, and if you remove for long-term debt and really just include for total assets are going to be well over 4.3 billion, but of that, intangibles are 1.6 and goodwill is 1 billion. So $2.6 billion for the company. Of the 4.3 billion is in intangible assets and goodwill, which is again very, very high. Although it has come down. I mean, total assets were 17 billion back in 2021. They have come down significantly. But again, goodwill as a percentage of assets is still very, very high for the business. I'd be surprised if I see any positive free cash flow. So if I remove everything here, come down, we've got some free cash flow that's in the positive in 2023 of almost 200 million. But let's just take a look at it on a quarterly basis. Last quarter, negative free cash flows over 26 million. The prior 3 quarters were positive. If you come over, take a look at the last 16 quarters, for example. Again, it's been a little bit more inconsistent for the business at the moment. It's just been up and down and all over the place. Now, if you come over to analyst estimates, we've got a hold rating with a low target of $10, average target of $16.95, and a high target of $26 with, again, earnings not expected to be positive anytime soon. It seems like 2028 is when the earnings are expected to be positive for this business, and revenue is also expected to increase by about 4 to 5%. And then start declining after 2031, topping out at $3.5 billion for the company. So we can't really use any of our calculators to understand what's the intrinsic value for Teladoc, but this stock would be a hard pass for me at this moment. Sure, we've got a huge support sitting right at 2016 levels at $8.92 to $9 a share, but this is a stock that I think is a company that's on the verge of really just selling off, and again, not seeing any type of recovery anytime soon because business fundamentals are quite literally very, very bad. They're obviously not that great, and a lot of the things, like I said, you can visualize and see on the platform and get a better sense and better idea of how this company, or any company for that matter, over 17,000 of them are doing. So the bottom line is I would stay away from Teladoc for the foreseeable future, unless of course they can turn things around. When it comes to their business fundamentals, they can start turning out, good profitability. And again, one more thing, speaking of profitability, if you come back over to fundamental analysis, and if you simply go over to, let's say, gross profit and operating losses, right? So you'll notice that this has continued to happen, right? Quarter over quarter, if you come back over to 12 quarters, every single quarter, they have generated an operating loss. So what could be the reason for this is because their research and development and SG&A is probably too high. So if we plot for these two numbers, you'll notice that they are spending a lot of money on selling general administrative expenses, $349 million, and about $81 million in research and development. So considering that this is a Teladoc, this is like a healthcare technology company, they should be spending more money on research and development. No, it is a very, very small portion of their entire operating expense budget. Most of the money is going towards SG&A, $350 million, right? So if you do the math, 350 off of their entire operating expense, again, if you remove for gross profit and if you just plot for total operating expenses here, which are close to 430 million. So again, if you do like 350 divided by 430, we're looking at about 81% of their entire operating expense is going towards towards selling general administrative expenses. God knows what they're spending money on, how many salaries, what are they paying people. I'm sure it's including for stock-based compensation, which is a huge chunk of the entire piece of the operating expense budget as well. But the bottom line is they're spending more money than they're bringing in. That's the bottom line. That's finance 101. If you're spending more money than what you're bringing in, you will generate a loss. And that's exactly what's happening with this company at the moment. And again, total operating expenses very, very high. And if you compare that to gross profit, again, they're kind of neck to neck, right? They're very, very neck to neck. In fact, gross profit's 451, operating expenses 430 million as of the recent quarter. But every single quarter, again, it's been very, very neck to neck. And that's why they're either breaking even or generating a small loss every single quarter on an operating basis. Forget about net profit, right? So that's where we are with Teladoc. And like I said, support level is going to stay put at $8.92, close to $9 a share. I'm pretty sure the short interest is going to be pretty high for this stock as well. So be careful, be aware of what you're investing in. That's why we built this platform to help you better navigate higher quality companies, businesses, and companies that are doing much better. You can kind of filter out some of the noise and really try to analyze and research some of the higher quality companies. Like, for example, ELF, right? ELF is a fantastic business. Just to give you an example, right? If you come over here, much better, much cleaner fundamentals. The M scores, 3.18. And if you come over here, again, you can start plotting in for a lot of really amazing data points, such as the growth and the profitability. Not to mention, of course, the margins, the efficiency, the valuation table. Everything is going to be available on the platform for you to plot and play around with. So hope you all enjoyed this video, found it helpful. Make sure you drop a like and also do subscribe, join our MoneyVest platform. Link's going to be down below with a 51% discount available. We're going to be doing our beta launch here very, very soon in less than 8 days. I'm just waiting from the developers to give me the green light and we are all set and good to go. So happy investing. I'll see you all in the next video.